Okay. Hi everyone. Once again, we have I have to go to the countryside for 2 weeks. So the last week will be the video, and today will be the video again. Okay. We continue with the chapter 3. Okay. With this video in like 18 for the class of 18 March. Okay, well, for the class of 18 March, continue with the chapter 3. Okay, the chapter 3 is about the balance sheet and income, like balance sheet and its component. Okay, for the chapter focus is about the understanding of the balance sheet, also the accounting equation and the component of the balance sheet, and the transaction of the transaction behind the balance sheet. Okay. For the understanding of the balance sheet is imagine that you make a list of everything that very important to you, but along with this list you attach the value of all of these items, and then you make a list of everything that you owe to others, and again you attach the value to this item, and then you subtract or minus the total value of the second list from the total value of the first. Okay, finally you just create the basis of the component of the balance sheet. Okay, let's see. In a business, the first list of the item is called an asset. The assets are the valuable resources owned by the business and can be either short-term and long-term in nature. So this one is asset. The second list of items is called as the liabilities. The liability is are what you owe to others for the resources that were furnished to the business. The parties to whom the company owe money are normally called as the creditor, and the creditor are said to have a claim against the assets. So this one is where do liability come from? Okay, this figure 3.1 will show the origin of the liability a company or individual might incur. Okay, where the liability come from. So you have two columns as what they are called and where liability originate. Okay, they are called the account payable for the item, the purchase item, the purchase of item. So this liability will come from the purchase item. But for weight payable, they are called as weight payable, where this liability originate by the services from the employee, but the company not pay yet. Okay, but for the utility payable, they call as utility payable is where this liability originates is as the utility used but the company not yet paid for. And the next one is notes payable. For notes payable is IOU, is liable, where is liable originate is IOU. And the lend payable is come from the unpaid lend that company has. So this one is the liability, and they are what they are called and where they come from. Okay. And for the third list of that can be labeled as the owner equity. For the owner equity will reflect the amount of the owner has invested in the firm. So there are two sources of the owner equity. For the first one is the amount of money provided directly by the owner or the other investor. So this one is called as the owner investment. And the second one is the amount retained from profit. So this one is amount retained from profit, we'll call as the retained earning. So it means that the financial statement as the balance sheet will have three lists as the asset, liability, and owner equity. And the owner equity comes from the owner investment and retained earning. Okay. So profit takes many forms. For the profits are not always cash, as the profit can made up of the promises to pay money as well. For example, when there is a sale for receivable, there will be the revenue of the company, but no cash coming in the company. The money will come during a later time period, but can be considered profit for the company. So this one is about profit. Let's look at an example. For the example is the Solana Beach Bicycle Company. It's a small business that makes, also repair, also sell the bicycle. So let's say as the example of us in this chapter, the company was started by Samantha Fernandez in January 2006. Okay, we know that the history of this company. Samantha or Sam has been like bike rider for many years. Okay, so she has been a bike rider for many years and always felt she could build a better mousetrap or bicycle. So she invests some money she has saved and saw that she had inherited into her business. So she created the business. To take a look at the bicycle company balance sheet. Okay, we will take a look on the bicycle company balance sheet on the next picture. This is the proprietorship. This is the type of the proprietorship business because Samantha or Sam is the sole owner of the company. So the balance sheet will look a little different from the corporation or the partnership. Okay, so let's take a look this figure 3.2 as the Solana Beach Bicycle Company. As I said, we start with when you read the financial statement, we'll start the top of the head of the paper will be the name of the company as Solana Beach Bicycle Company, and the second should be what is the type of the financial statement. So this one will be the balance sheet, and this balance sheet will be right up on 31st of December 2006. Okay, so this one is say at the balance sheet of the year 2006 and report on the December 31st of 2006. Okay, by look at the bicycle company balance sheet, you can see there are several assets belonging to the company that together the value of 93,385. So this one we see on the picture, and the asset is belong to the company and the total asset will equal 93,385. Okay, and you can see that the company has several liability. several liabilities. So this one is the liability part. The total liability is $23,000, value at $23,000, and finally when you subtract the liability from the asset, you can see the company equity, or the owner equity. Okay, so you can see at total owner equity will be come from as I say from the last slide, the owner equity can come from two sources as the owner investment and retained earning. You sum it up at 60,000 plus 10,385. You will get the total owner equity as 70,385. Okay, and this will represent a combination of amount of money that the owner has invested into her business. So you can see as her own Sam invests as 60,000, and the profit was earned and retained in the business since inception as 10,385. Let's say the whole year the retained earning is 10,385, and the total will be the total owner investment will be 70,385. You will get here. Since this is the first year of business, all of the profits has been earned by this year. So retained earning, this is the profit that earned by this year. But for you get the total liability and total owner equity together. You sum up from 23,000 plus 70,385. You will get total liability and owner equity as 93,385. So this side will be equal as asset equal liability plus owner equity. So what's that the date on the balance sheet mean? So this one, what does this mean for the 31st of December 2006? So this is a great deal of the disagreement as to how accountants arrive at the value that show above on the balance sheet. Most concern are the value attached to the asset and consequently to the owner equity or net worth of the business. So the balance sheet represents a snapshot of the financial position of the business on that specific date. So in this case, we'll show the balance sheet of the Solana Bicycle Company in this point of time will be 31st December 2006. Next one is about what is historical cost. You can remind yourself about the chapter 2, the historical cost concept. So once again, as you see above, all of the item, all of the balance sheet of the item have the value attached to them. But where does this number come from? So you can see at the balance sheet how the value this come from for each one. Okay. In United States, the accountant or the other user of the financial statements has agreed in the financial statement include balance sheet, because there are 4 types of the balance sheet of the financial statement: income statement, balance sheet, state of retained earnings, state of cash flow. So the statement when we call at the financial statement is include the balance sheet. So it must be based on the historical cost in US. It means that the value on the balance sheet of the Solovay Bicycle Company does not represent what the asset or the liability would be worth today if they were be sold. So instead, the value represents what was paid for the asset and what the business agreed to pay to the creditor on the date of the obligation. So, does this confuse the reader of the financial statements? No, because everyone has agreed to follow this convention. Everyone preparing and use this financial statement understand the language that has being spoken. Okay. You should start with this one when you think about the accounting. The accounting equation. Often the relationship between asset, the contraction as A, liability contraction as L, and owner equity or contraction as OE are shown in the term of the formula A equal L plus OE. So it will be equal to the asset equal to liability plus owner equity. And please keep in mind that owner equity comes from two sources as the investor, the owner investor, and retained earning. Okay, keep in mind for this one, account equation A equal L plus OE, asset equal liability plus owner equity. Okay. For the total asset of the company will equal to the sum of the liabilities and the owner equity. For the formula, depict the relationship of the various elements of the balance sheet. For the balance sheet are often set up with the asset on one side, at the left side, and the liability and the equity on the another side as the right side. So it means as the same as the formula can be stated in this way. If you change the sign from A equal L plus OE, change the sign, L will be minus to the A minus L equal to OE will be asset minus with liability will be equal to the owner equity. So this one is you change the sign of the equation. If you subtract the liability from the asset, the left side you will get the owner equity of the business. So this one. The next one is about the components of the balance sheets. You already see at the figure 3.2 about the picture of the balance sheet. They will start with the first list is the asset. As discussed above, assets are the items that are of value and are owned by the entity of which you are accounting. Let's make this idea more specific. As for an asset to be listed on the balance sheet of the company, the item must be passed these three tests. Okay, these three tests is big. This figure 3.3. How do we know when the assets go on the balance sheet? Which one should be posted on the balance sheet? Which one should be not listed on the balance sheet? So please follow this item. This following item give us some hints for this test. The first one, the company must control the item. So this usually means the ownership of that asset. And the second one, the item must have some value to the company. Must have some value to the company. And the third one will be the item must have value that can be measured. So this one is three tests of the how asset we should like list on the balance sheet. If they pass 3 tests, they should list on the balance sheet. Let's look at some example. Before the test list, the traditional balance sheet does not list the employee of the company, even though we may refer them as the asset of the company in non-accounting sense, because the company does control over the employee to certain the extent, but not on each individual employee. But what about the basketball players? Think about the basketball players or the other professional athletes. So, does the team own them? The answer is no. The answer is no. What the team owns is not the player themselves, but is the player context. Okay, so as this situation, the basketball team ownership would list the contracts of the player as the asset of the company. With the second test, almost anything that's used in the business to earn the income and to generate the cash does have some value. So, certain items that do meet the requirement might be eliminated from being listed as the asset by this test. Okay, should pass 1 and consider the 2 tests. The second test, the example might include the old truck that does not work, or inventory that cannot be sold for any longer time because it's maybe out of date today. So, the old version, for example, the old version of the company software. The computer software. The old version of the computer software. As the example of the second is anything that's used in business that can earn income and generate the cash that have some value. So this one, the old version of the company software should not list on the balance sheet for this one as the asset. Should not be on that, because the old version of the computer cannot be like the companies the business cannot be like earn any income much or generate cash to have some value. So this one it should not record as the asset. And the example of the third state is when the company purchase used machine. The company purchase is for the fixed amount of money and has a record of this transaction that clearly indicate the value of the machine. So neither the company nor the balance sheet deal with over or underpaid amount of the machine, but the balance sheet reflects only the historical, with what is the record as the amount paid of the machine. Whether the company pays too much or got bargain on that. So this one is about the third key as the company purchase or value has have the item that has value on that and can be measured. So this one is the third key. Continue with this one. Let's assume that a company has built up a thriving business, and some of a reason for this growth are the reputation of the owner and location of the company. Either reputation of the owner nor the location of the company has been paid for. We also don't have any way to measure the value to put onto this item. Therefore, they failed the third state, so they cannot be listed as the asset on the balance sheet of the business. So another example of the asset would fail the test as the asset that was given to the company. In this situation, there is no historical cost to the company, and thus the asset cannot be reflected on the balance sheet since it does not meet this third test. So now you might say that you can determine the monetary value of this asset. In many countries, this asset would then be reflected on the balance sheet at that value. And under the GAAP in US, since there was no historical cost to this asset, it won't to be leased to not be leased on one of the company assets. And the asset, we talk more about the asset. They divide into two, are the short-term asset and long-term asset. For the assets are normally this subdivide on the balance sheet into two categories. For first one as short-term asset or the current asset. You can call it the current asset or short-term asset. This item will use or convert into the cash within a period of 1 year or less. So this one is a short-term. Due date is 1 year. And the long-term asset, also called as non-current asset, are not expected to convert to cash or totally used up in a year or less. So this means that they are expected to be valued to the company for more than 1 year. For long-term assets would be included as the equipment, the land, also the building of the company. But for next one is about intangible asset. The intangible asset are the asset that cannot physically touch. So they must still meet the three tests mentioned earlier in order to be listed on the balance sheet as the asset. However, they don't have any tangible characteristics. Some of the examples of these intangible assets include the trademarks, also the copyrights, also the patents, as well as they have been purchased from the prior owner of the business. You might be inclined to call goodwill as the intangible asset. For the goodwill is based on the location of the business, reputation of the owner, also the name recognition by the public is the great value to the business, but it is the intangible asset. But keep in mind, because the GAAP discussed in chapter 2, this and any valuable item which was not paid for and not have historical cost, it cannot be listed on the balance sheet as the asset. The next one is about liability. Okay, the asset have two other short-term asset or current asset, and the second one is long-term asset or non-current asset. Okay, the second one is about the liability. For this one is liability is referred to this picture is a picture of figure 3.2 as the balance sheet of the Solana Bicycle Company as our example. The total you can see from this one. The liability you can see as the account payable, mortgage payable will be equal to the total of liability. Okay, the total liability of the business are equal to 23,000. As with asset, liability list also represent short-term and long-term items. Similar to the list of assets, short-term liability will pay off in a period not to exceed 1 year. But for long-term liability will remain as the debt to the company for longer than 1 year. So the due dates also be 1 year. With this and other long-term debt, the portion of these become due and payable each year, and most company balance sheets will show the current portion of the long-term debt separate from the short-term liability section. So this one you can see they have two, okay, but you will know at the liability how to divide at the long-term liability and short-term liability, or can be called a short-term debt or long-term debt. Okay. The last one is owner equity. As we discussed, the equity of the Solanabis Bicycle Company come from two sources, as the owner investment of $60,000 represent the amounts invested in the business by the owner through to purchase the various assets, or as the money in the bank that meant for the business. So this one is the invest of the owner as 60,000. And the second part is the retained earning. Retained earning is represent as the amount of profit earned by the business since its inception minus with the money that owner may take out of the for the personal use. So this one is 10. The retained earning equal to 10,385. Okay. You will get from two sources, and the total owner equity should be 60,000 plus 10,385. So it will be equal to 70,385. And for this one, to understand cash and retained earning, let's take a moment for clarify a very important point about the retained earning that often cause the confusion among the owner of the small and large business alike. The retained earning in the business is not equal to cash. Is that is cash at the money in the bank. It's just because a company has created profit in the business over the year, not meant that all of the profit have been retained in the form of the cash. For example, after the company earned a profit, it may take that cash and purchase this asset or pay off some of its liability. So the business owner will assume that they are doing well, they are making profit without taking into the account amount of the cash that they have at their disposal. And if they not have the sufficient cash, they will find themselves in their since they may not be able to make the payroll, pay their tax, or pay their other liability. This is absolutely essential. These businesses have a good cash management plan. So this one is about cash and retained earning. And this one is the revised to the balance sheet of Solanabis Bicycle Company. Use the most common subheading. Look at this picture as the figure 3.4. The first one should be expanded. It's called as the Solanabis Bicycle Company as the balance sheet, but record on the December 31st of December 2006. Okay, you can see at the chart they divide the asset to two parts, at the short-term asset and long-term asset. For short-term asset can be cash, can be account receivable, but minus with allowance for doubtful accounts and plus with the inventory, also the prepaid insurance. So the total short-term asset will be, this one is, you sum it up, but this one is minus. So I think maybe I use the calculation for you to understand. The cash 17,385 plus with account receivable 9,175. Okay, but you need you have the allowance for doubtful account is the account that you cannot receive. They is the doubtful account, so it's mean like you minus with 175. So you can see after in parentheses is 175 in parentheses is mean minus. Okay, but you should plus with the inventory. When inventory is the one of the short-term asset of the company. The value of the inventory is 23,000. Okay, but plus with the prepaid insurance. So this one is the insurance that prepaid to that year is plus 1,000. So the total short-term asset will be equal to 50,385. Okay, let's see big picture. But for long-term asset are the truck, also the land, also the building, also the machinery. So this one is the type of the long-term asset. As the example, for the truck is 8,000, the building is 25,000, and the land is 10,000. So you sum it up. Okay, I will a little bit show the calculation for that. The truck is 8,000 plus the building as 25,000 plus with 10,000 of the land. The total long-term asset will be 43,000. Okay, but you need to sum it up as total asset. It's come from the total short-term asset and total long-term asset. So this one is long-term asset 43,000, but you should plus with short-term asset 50,385 will be equal to the total asset at 93,385. Okay, but okay, let's see for the next one as the liability and owner equity. Okay, liability and owner equity. For the short-term equity, once again, asset has short-term and long-term. Liability also has short-term and long-term. This one is separate for the reader to understand easy. As the short-term liability as the account payable and current portion of the market payable. So this one is the short-term liability. But what is the long-term liability? Maybe can be the market payable that more than 1 year to be paid. So this one will be calculated as, okay, I am sure to calculate it as this one. For the short-term liability has account payable as 3,000, but plus with the current portion of market payable as 1,000. So this one as the short-term assets at 4,000. But the short-term liability. But for the liability, we have long-term. Market payable that paid more than 1 year will be market payable as 19,000. So the market payable will be long-term. liability, but plus with the total short-term liability at 4,000. 19,000 plus 4,000 will be equal to the total liability as 23,000. Okay. And the next one is owner equity. Maybe you can see from this, the owner equity as two parts of the owner equity. The owner equity come from the owner investment as 60,000. Owner Sam invest, okay, is 60,000 plus with retained earning during that year is 10,385. Okay, the retained earning of that of the year will be 10,385. Normally the retained earning is come from the last year, but this one is the first year. So this one is come from the January until the December of the 2006 of this report of the balance sheet of Solana Bicycle. Okay, so you will get 70,385 as the total owner equity, and you can calculate it as the total liability and total owner equity will be total liability as the 23,000. Oh, sorry, 73,000, but plus with the total owner equity as 70,385 equal to 93,385. Okay, so this one you can understand how we calculated in the balance sheet. Okay, next one. The transaction behind the balance sheet, as referred to this picture as figure 3.4. Let's examine the transaction created it. Okay, let's see as the first one. Sam invests the money in the company. So this one is referred to the owner investment. First, let's assume that the January 1st, 2006, Sam invests 60,000 in her bicycle company. In other words, it means that she takes 60,000 out of her personal bank account and set up the new account with the bank of the new business. So after this transaction, the company balance sheet will look as this. Figure 3.5, the balance sheet of January the 1st. January the 1st is the first one that set up and Sam invest. So it means that the asset should be the cash that Sam take from the bank account to invest into the business. So the cash will be 60,000. But the part of owner liability is zero because they don't run business yet, so they affect the owner investment. For the owner equity, we have two costs as the owner investment, but for retained earning, we don't have for the 1st of January. So it reflects the owner investment as 60,000. The 60,000. So two sides of the equation is equal. A equal L plus OE. Asset equal liability plus owner equity. So two sides is balanced. For now is 60,000. Okay, let's see the next transaction as the Sam purchase land and building and truck. Sam purchase land, building and truck. Next, on January 1st, the bicycle company buy a piece of land which is a building and a truck in order in order to operate her business. The land has value as 10,000. So you should know as the land, building, and truck record as the long-term asset. So the land value as the 10,000, building value as 25,000, and the truck will use for pick up and deliver bicycle value as 8,000. So all of these value are actual amount of the company paid. So because of company does not have sufficient cash to pay for all of the assets at the current time, it decides to borrow some money. It pays 23,000 in cash, but take out of mortgage on land and building 20,000 to purchase this asset. This is the 20 years loan. $1,000 is of this loan is due and payable within 1 year. So this one is the situation that occur during the business. They set the business and they need to buy or purchase the long-term asset. But somehow they don't pay in cash. They pay in the take out the mortgage of land and building to purchase this asset. So this one is making a loan. This one is making a loan, and the time of the loan is 20 years, and the one of $1,000 of this loan will be payable within 1 year. So after this transaction, after this information, the company balance sheet will look like this. Okay, will look like this. Normally I think I should. Okay, the figure 3.6 will be the balance sheet in the of the Solarnabis Bicycle Company. But one again in the 1st of January. Okay, but they not only have the cash 60,000, the owner investment 60,000, but they buy the land, the truck, and the building. So you could see as the short term. How they will be the 37,000. It means as from the last figure, the Sam invest the cash at 60,000. So, but minus with 23,000, you will get 37,000. So, how it come at 23,000? So, you see 23,000. See as this one. You see at this one first. You have the land that value 10,000 and the building value 25,000 and the truck that have value in 8,000. So it will equal to 43,000. So the total long-term asset is 43,000. 43,000. But for this one, you should understand that they paid for cash in 23,000. 23,000. So the cash will minus 60,000 minus with 23,000 equal to 37,000. Okay, and this one for long-term asset buy at truck not 8,000, building 25,000, and land is 10,000. Total long-term asset is 43,000. So you sum it up with short-term asset and long-term asset at 37,000 plus 43,000 is will equal to the total asset at 80,000. But for this side at the asset at the liability plus owner equity, the current portion of mortgage is 1,000 and the long-term mortgage payable is 19,000. So it is how come the information is held at the loan of 23,000 1,000, but divide in short-term portion as 1,000 as this year. But for long-term portion will be the left is 20,000 minus with 1,000. The long-term portion will be 19,000. So the total liability will come from the current portion of mortgage payable is 1,000, but for long term, as the 19,000, the total liability will equal to 20,000. But for the owner equity, will be the owner investment as the same as 6,000. So you sum up with the liability plus owner equity. 20,000 plus 60,000. The total liability and owner equity will equal to 80,000. So this one, okay. If as you see on that figure, the cash balance decreased by 23,000 is the amount of cash contributed to purchase land, building, and truck, and the other assets have increased the 43,000 because you buy the trucks, the land, the building. Is the total value is 43,000. And then you have two new liability that appear at the current and long-term portion of mortgage loan. For the mortgage loan is 20,000 loan. That like they say 20,000 loan for 20 years. Is divide up between short-term portion for this year is 1,000. Is 1,000, so long term is 20 minus with 1,000 for long term portion of the mortgage payable or mortgage loan will be 19,000. So the owner equity will be equal to so that one is the part of liability, but for the owner equity will equal to the same, not affect as 60,000. Okay. What are the factors that change the owner equity? The item below gives us the summary of the only item that have impact on the beginning balance of the owner equity. The first one, owner invest more money in the business. So this one will plus in the owner investment. But the next one is business makes a profit or loss. So this one will reflect to the retained earning. And the owner take asset out of the business. So this one is the part of like owner equity will minus. Okay. So when Sam invests 60,000 into the bicycle company, this increases her owner equity in the company by the same amount. When the company makes the profit, it's also increased to the owner equity. Finally, if Sam decide to take the money or the other asset out of the bicycle company for her own use, this will reduce the owner equity as it shows up on the bicycle company balance sheet. So the next transaction is Sam purchase insurance. Sam purchase insurance. This one insurance is at the short-term asset. So on the information given as on January the 3rd, the company purchased 3 years insurance policy, 3 years insurance policy on the building, and the cost of this insurance is total is 1,500 of the 3-year insurance policy. Because this purchase covered 3 years, at the time of purchase not being used up at all, the expenditure represent at the asset. We call this asset as prepaid insurance. So the company paid for this insurance with cash Okay, prepaid insurance with cash, but they will be the 3 years policy insurance. How we record? So the only change in the balance sheet after purchase the insurance is that the asset cash has been exchanged into another asset at the prepaid insurance. Is between like short-term or long-term asset. So cash exchange to the other asset. So for the exact amount of 1,500. So it means that for the short-term asset part, you will record the prepaid insurance at the cost of 3-year insurance policy on the building is 1,500. So the insurance expense per year will be equal 1,500 divided by 3 years will be equal 500 per year. Okay, but for next one, Sam order and buy bicycle. So they run Sam, she run the business. So the January the 5th, information given as the January the 5th, Sam order and buy 2 different brand of bicycle from 2 different company. Sam buy the 80 of one kind that cost 100 a piece. So one bicycle, 30 bicycle, 100 cost 100 per bicycle, 100 a piece, and 25 other kind cost her 200 a piece. So the total cost the company will get 105 bicycles. So this one is 80. So 80 plus 25. The company will get the inventory at 105 bicycle. The value is you can calculate. So this one I will calculate for you. Calculation. Okay, for the calculation, 80 multiplied by 10 will equal to 8,000, but 20 plus multiplied by 200 at the cost. So it's for the 80 will cost as 80 will cost at 8,000, but 25 will cost at 5,000. So you sum it up. Sum it up is 5,000 plus 8,000 will be valued as 13,000. So this one is at this. The total cost of 105 bicycle to the company is value 13,000. This purchase represent the short-term asset as the inventory. So you add up with short-term asset, add up with the inventory. Inventory, the cost is 13,000. So 13,000, you add it up. This one is the same, prepaid insurance is the same. So the short-term asset will be equal to 37,000. Okay. The next is Sam order and buy bicycle at the short-term asset. For inventory is the short-term assets because the company anticipate sell these 105 bicycle in a year or less. Like with the purchase of the long-term asset, company does not want to pay all these bicycle in cash, so they pay as 10,000 in cash, but agree to pay additional 3,000 to seller at the later date of sale. So it means that It means that we need to record at the minus 10,000 in cash, but we need how 3,000 is record. These 3,000 become an account payable of the business that shown in the short-term liability section. As the liability section, you add up with the account payable 3,000. And the next one, so the total of these sum up for total of these, you can see at the figure 3.1, there's like several different type of payable. As the term of account payable is reserved for the purchase of inventory item that going to be resold by the company. So after this transaction, the balance sheet will look like this. Figure 3.8. At the Solana Beach Bicycle Company balance sheet and the date of 5th of January 2006. But for the asset is 327. This one is 37,000 but minus with 10 because you pay for this one as buying bicycle for sale, but you pay in cash only 10,000. So the cash will be 25,500. And the inventory is equal to the all of the inventory of the bicycle as 8,000 and 5,000 will be equal to 13,000. But you prepared insurance for the building as 3 years 1,500. So you sum it up as 25,500. Plus 13,000 plus 1,500, you will get total short term at 40,000. Okay, but for long term, the sum by the truck, by the buildings, by the land is 8,000, 25,000, and 10,000. So the total long term asset will be 43,000. So you sum it up, it's 40,000 and 43,000 will be equal to the total asset at 33,000. But for this side A, don't forget the accounting equation at asset equal liability plus owner equity. So this side it start with liability. For the liability, so this one is account payable is 3,000. So this one is come from this one. Okay, this one as we agree to pay the additional 3,000 to seller for the bicycle we buy. So this one is account payable 3,000, sorry, and the current portion of market payable and long-term market payable. So this one is come from the last will be this one. Sorry, will be this one. As the loan as 20,000 of loan as 20 years, so it divide into 1,000 per year. So this year the short-term portion will be 1,000, but the left will be long-term portion as 19,000. So we go this one. I go back to let you follow to understand. Okay, so you sum it up is the account payable 3,000, current portion of market payable 1,000, and long-term market payable is 19,000. The total is sum it up 3,000, 1,000, and 19,000. Total is the total liability is 23,000. But you still have the owner equity. For this one, owner equity come from two: owner investment and return earning. We don't have the return earning because this one is the first year, and the owner investment will be from this in the first year, but today is the first like is 5 5 days. So maybe we don't have the profit yet, so the retained earning we don't have, but we have in the past of the owner investment at the first is 60,000 of Sam invest. So you sum it up and decide the liability plus owner equity. Total liability is 23,000 plus 6,000 will equal to the total liability and owner equity as 83,000. So this equation is balanced as the balance sheet. So this side is balanced at 83,000. So you can see as the red color is the asset is 83,000 equal to the liability 23,000 plus the owner equity as 60,000. So balance is balance, and once again the balance sheet stay in balance as asset 83,000 like equal to liability 23,000 plus owner equity as 60,000. You will note that the balance sheet in the figure, last figure, date January the 5th, 2006 is quite different from the date that on December 31st of 2006 on the figure 3.4. So it shows that how balance sheet can change and represent the company asset, liability and owner equity in any given point in time. So in this chapter, you have learned about the balance sheet and definition of all of its items, and have learned how these components related with each other, and you have learned very important point of the retained earning not necessarily comprised of the only cash. Therefore, the cash management is high priority to the business to making a profit. Okay, and finally you have learned how various transactions affect the balance sheet for the small business as our example Solana Beach Bicycle Company. So that's all for today, and we review as the glossary of vocabulary as the Excel equation A equal L plus O, asset equal liability plus owner equity. The formula depict the relationship of various elements of the balance sheet: asset, liability, owner equity. And account payable is the short-term liability or short-term debt incurred from the purchase of inventory, and the asset is the item of the value that owned by the company and are represented on the balance sheet. Okay, and the balance sheet is this financial statement that lists of the asset, liability, and owner equity. Okay, the relationship will all these will represent by the accounting equation as A equal L plus OE. And the creditor is those individual or company who to which money or other asset are owed is like for example the supplier from who Sam purchased the bicycle, to who she owed additional 3,000 is the creditor of the company. And equity, so owner equity you can see as the owner equity they come from two sources as owner investment and retained earning that come from profit. And the cost, historical cost, this one related to the chapter 2, that is the amount paid for the item owed by the business, or the amount incurred in a debt on the date of agreement that enter into the obligation. So this one is historical cost. And the intangible asset are the asset that are of value to the business and meets all tests of the being asset but not have tangible quality. For example, the trademark or the patents. So this one is intangible asset of the business. And the inventory is the asset held by a business for the purpose of resale. So this one is called as the inventory. For the inventory, as our case is our Solana bicycle company, the inventory will be the bicycle that company intend to sell. And the next one is about the liability. So the debt owed by the business. So they can either the short term and the long term depend upon when they become due. Okay, this one is liability. And the asset can be short term and long term. So I start with the last one. The short term asset is the asset that that are cash or will convert to cash or consume within a period of 1 year or less. But for the long term will be item that will be consumed or convert into cash after a period of 1 year. So this one is long term. For example, for short term can be cash, can be account receivable, can be inventory, can be prepaid insurance. But for long term asset can be truck, can be machine, can be land, can be building. So this one is long term. But for the owner equity, once again, long owner equity comes from owner investment and retained earning. For the owner equity, difference between what is owned and what is owed in the company. This amount belongs to the owner. The owner equity will make up the original and additional investment by the owner is called as owner investment, plus the profit that retained in the business is called as retained earning. Okay, so this one is owner equity. But for the retained earning is amount of profit earned by the business since its inception, but minus with the money that take out or contribute to the owner. So this one is about the retained earning. So this one, the assignment tree. This one is assignment tree. So below this is the list of the item that might be considered as the asset by the company. Indicate whether they should be listed on the balance sheet as the asset or not. Okay. The question is state that given is should be listed on the balance sheet as the asset. Why or why not? Okay, they have 10 questions. As the first one, a bicycle that belongs to the owner of the company. A building used to build and sell the bicycle of the company. A broken tool that are not used in the business any longer. Employee. Money owed to the company from the sale of the bicycle. Money owed by the company to the gas company. The land that company building is on. The truck used to deliver the bicycle to the customer. The money in the personal bank account of the owner, and the money paid in advance for 3 years insurance policy on the business. So you should say that the first one is list on balance sheet, yes or no, and why or why not. Okay, it list as the asset on balance sheet, yes or no, list or not list, and why not. Send this assignment tray in to my email before, so the due date should be before 18 March midnight. Before 18 March midnight. The email title, the assignment tray following the student ID and the name. Okay, this one is assignment tray. Okay, please do it. Okay, I try to help you, and I think this is sorry, I think this is complete for this chapter. This chapter is about the balance sheet and its components, what they show on the balance sheet and how they calculated and value each one in the component of the balance sheet. So this one is chapter 3. That's all for today. Okay, thank you everyone. After this, I think hopefully that I don't have to work to the countryside again. So, but if they have, so maybe I do the video again. But for this one, I record the chapter 2 and the chapter 3 because I need to go to the countryside for 2 weeks. Okay, for 2 weeks. So that's all. If you have any question, you can contact me anytime by WeChat or my email. It's okay. Thank you.